Hey there, savvy travelers and investors. I'm Iggy, your go-to guide in the world of investments, straight from the Investing Iguana channel. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers. Today, we're navigating the skies with Singapore Airlines, a name synonymous with quality and resilience in the airline industry. But here's the twist: despite its stellar performance and record profits, it's been rated a hold by Darren Beckhai of the Aerospace Forum. You're probably wondering, why, Iggy, why? Well, stick around, because we're about to take off into a comprehensive analysis of Singapore Airlines' recent financial journey, the challenges it faces, and what this rating means for investors like you. From fuel costs to fierce competition and everything in between, we've got it all covered. The Aerospace Forum is a subscription-based investment research service that provides in-depth insights on the aerospace, defense, and airline industries. It is considered the #1 aerospace, defense, and airline investment research service globally. On the other hand, the Aerospace and AMP Defense Forum is a global aerospace and defense leadership community that provides mutual support and encouragement, partnering, innovation, and performance breakthroughs. It is a platform for industry senior executives, investors, government agencies, nonprofit and professional associations, and entrepreneurs with a strong interest in the aerospace and defense industries to connect and collaborate. The community currently consists of 9 chapters and over 2,500 members. Today, we're taking off with a close look at Singapore Airlines, a titan in the industry that has been making headlines and catching the eyes of analysts and investors alike. Our journey today is centered around an in-depth analysis that transitioned from a cautious hold to a buoyant buy, and now, intriguingly, back to hold. We'll dissect the dynamics behind this rating rollercoaster, explore Singapore Airlines' latest financial altitude, and chart the course for what lies ahead. Fasten your seatbelts as we soar into the financial stratosphere of Singapore Airlines, decoding the metrics that matter and unraveling whether this airline is set to cruise or brace for more bumpy rides. In the final month of 2022, Darren Beckhai, an analyst from the Aerospace Forum, initially gave a hold rating to Singapore Airlines. This was due to the uncertainties brought about by the seasonal fluctuations of the COVID-19 pandemic and the competitive pressures in the airline industry. However, as the situation improved and the pandemic's impact lessened, Singapore Airlines began to report record-breaking profits. This positive financial performance led to an upgrade of the stock to a buy rating. As we moved forward, the value of Singapore Airlines stock saw a significant increase of 17.5%. This is a commendable achievement, even though it slightly lagged behind the overall market's performance. The upward trajectory of the stock value is a testament to the company's strong financial health and strategic business decisions. Our analysis now brings us to the first half of the fiscal year 2024. During this period, Singapore Airlines revenues saw a substantial increase of 9%. This revenue growth was accompanied by a significant capacity increase of 19.9%, indicating a strong revival in passenger traffic. This is particularly true for routes in Asia, which have seen a robust recovery as countries in the region have started to reopen their borders and lift travel restrictions. This signals a promising future for Singapore Airlines as it continues to navigate the post-pandemic world. Indeed, while the passenger traffic shows a promising trend, the cargo sector of Singapore Airlines paints a different picture. The load factors, which measure the cargo capacity utilized, have dipped below the levels seen before the pandemic. This downturn raises questions about the future performance of the cargo sector and its ability to contribute to the airline's overall profitability. On the operational side, the total costs have escalated by 5.6%. This increase in costs is a concern, especially in an industry where cost control is crucial for maintaining profitability. Interestingly, the fuel costs, after hedging, have decreased by 15.3%. This showcases the benefits and risks of fuel hedging, a common practice in the airline industry to manage the volatility of fuel prices. While it has helped to reduce fuel costs in this instance, it can also lead to potential losses if the fuel prices move in the opposite direction. The non-fuel expenditures, on the other hand, have climbed higher than the capacity growth. This indicates that the unit costs, which refer to the cost incurred per unit of output, remain a challenge for Singapore Airlines. Despite the expansion in capacity, the airline has not been able to achieve the economies of scale that would typically lead to a decrease in unit costs. This is an area that the airline needs to address to improve its cost efficiency and enhance its profitability in the long run. The financial performance of Singapore Airlines in the first half of the fiscal year 23-24 has been impressive, with a 26% increase in profit. The second quarter of the fiscal year was particularly strong, with the operating profit reaching an all-time high. This shows that the airline has been successful in navigating the challenges of the post-pandemic world and has managed to improve its profitability significantly. However, looking ahead, there are several factors that could put pressure on the airline's profit potential. The volatility of fuel prices is a major concern, as it can significantly impact the airline's operating costs. The competitive nature of the airline industry could also pose challenges, as it could lead to price wars and reduced profit margins. In terms of valuation, while some industry analysts suggest that the airline's valuation could potentially double, the current EV/EBITDA, enterprise value to earnings before interest, taxes, depreciation, and amortization, ratio points to a more modest increase. This ratio is a commonly used valuation metric in the airline industry, and a higher ratio could indicate that the stock is overvalued. Furthermore, the anticipated decrease in EBITDA and free cash flow could also impact the airline's financial performance. EBITDA is a measure of a company's operating performance, and a decrease could indicate potential challenges in the company's core business operations. Similarly, a decrease in free cash flow, which is the cash a company generates after accounting for capital expenditures, could limit the company's ability to invest in growth opportunities or return capital to shareholders. Given these factors, the analyst from the Aerospace Forum has switched back to a hold rating for Singapore Airlines. This suggests that while the airline has shown strong performance, there are potential risks and uncertainties that could impact its future profitability. Therefore, investors are advised to hold their positions and monitor the situation closely. And that, my friends, wraps up our voyage through the financial altitudes of Singapore Airlines. It's been a flight filled with highs and some turbulence, highlighting the complexities of the airline industry. If this analysis helped you see Singapore Airlines in a new light, or if you've got your own insights to share, hit that like button and let's get a conversation going in the comments below. Your engagement is our fuel, so don't forget to share this video with fellow investors and aviation aficionados. Not a subscriber yet? Now's the time to join the Investing Iguana crew by hitting that subscribe button and turning on notifications. You wouldn't want to miss out on our next investment journey, would you? Until next time, keep your portfolios soaring and your investments grounded. This is Iggy, signing off. Safe travels and savvy investing, everyone.